Okay, hello everyone. Now in today's session, we are going to attempt another question of December 2022 attempt that's called PROPLIES company. So I'm reading the exhibits. The following exhibits on the left-hand side provide information relevant. So let's open it. So the question states that, let me zoom it, it's very small. So PROPLIES company and ADECTAN company are two listed companies. The main focus of both companies is publishing magazines, although they also publish a limited number of books linked to the magazines. So PROPLIES and ADECTAN, two companies are given. Both are publishing companies. They are publishing magazines. They also publish a limited number of books. PROPLIES publishes property and lifestyle magazines. ADECTAN publishes magazines covering professional sports. So one is property and lifestyle magazine, one covers professional sports. Both companies publish a combination of magazines which have been established in recent years and some of which have been published for much longer. PROPLIES has an in-house team of staff writers and editors who are responsible for content. Most are young and tend to stay for a limited time before moving on to other industry jobs. ADECTAN has a team of in-house writers and editors for each magazine who are specialists in the sport with their magazine covers, and in some cases have worked for the magazines for many years. Currently, successful sports stars also write for ADECTAN's magazines. ADECTAN company's board has given the managerial and writing teams of the most successful magazines considerable autonomy in determining the content and development of their magazines. So PROPLIES has in-house team. They're responsible for content. Most are young, but young people, they tend to stay just for a limited time in any company and then move. ADECTAN has a team of writers who are specialists. Some successful sports stars also write for magazines, and board has given them autonomy. Both companies have an online presence in addition to publishing paper copies of their magazines. Both have online presence. Electronic subscribers are both companies can access some content which is only available online, whereas PROPLIES has won awards for its online presence in e-marketing. ADECTAN's website has been criticized for looking old-fashioned, with the main appeal of its online offering being the high quality of writing of content which is only available online. PROPLIES is planning to make a takeover bid for ADECTAN and has contacted ADECTAN's board. PROPLIES believes that the acquisition could provide synergies, particularly in the area of online presence, marketing, and cross-selling, and also savings in staff admin and paper costs. So let's just summarize this scenario that PROPLIES, ADECTAN, they are two publishing companies, right? So there is one publishing company. There is one publishing company who makes property and lifestyle magazines, and the other publishes sports magazines. One has the staff and writers who are young, move on. Other has professional. They tend to stay many years. They have autonomy. Both companies have online presence. They publish paper copies as well as online. And PROPLIES website has earned awards, but ADECTAN's website has been criticized for looking old-fashioned. Okay. PROPLIES is planning to make a takeover bid for ADECTAN company. Okay, PROPLIES is planning to make a takeover bid for ADECTAN company. Okay, has contacted ADECTAN's board and it thinks that it will create synergies. Okay. Second one. The current market value of PROPLIES equity is 620 and ADECTAN's equity is 340. So both equity values are given. ADECTAN's board has indicated that its shareholders will expect a premium of 20% above the current equity value. PROPLIES board feels that the shareholders will also expect a gain of at least 20% of the current equity value of the shares from acquisition. So both shareholders have some expectations. ADECTAN, which is the selling company, it thinks that shareholders expect 20% above equity value. So its equity value is 340 million. They expect at least 20% above. That is 68 million more. And PROPLIES feel that shareholders want a gain of at least 20% of the current equity value from acquisition. PROPLIES wishes to estimate the equity values of this acquisition with free cash flow to firm method. Free cash flow to firm means free cash flow to company, where the discount factor is WACC. Information is expected revenue in first year when companies are combined of 720 million, sum of revenue of two companies for the most recent financial year, expected growth rate of 2 in each of years 2 to 4 of 8%. Post-tax operating cash flows in each year is to 1/4 of 14% of revenue. Additional investment in non-current assets of 25 million in year 1 and 0.3 for every $1 increase in revenue. After year 4, expected annual growth rate of free cash flow to form of 4%, cost of capital 10%, target debt to equity ratio of combined companies 1:3. Okay, I think the free cash flow is very easy for this. That's it. I think the information was just based on two exhibits. Okay. Requirement 1, estimate the equity value of the combination of Propolis and Addicton. So it has clearly said that Propolis wishes to estimate equity value of this acquisition with free cash flow to firm method. So you can find the equity value through free cash flow to firm method. This is the requirement 1, estimate equity value of combination of Propolis and Addicton. So equity value by combining two companies, that's through free cash flow method, and benefits which will be gained by PROPLIES shareholders from the acquisition. Only you need to find the gain for PROPLIES shareholders, not Addicton shareholders. Okay, let's find equity value through free cash flow firm method. Okay. Okay, now if you want to calculate the equity value combination, that is the combined company. The question is clearly stated that it should be through free cash flow to the firm method. PROPLIES wishes to estimate equity value with free cash flow to firm method. So since you have to find the equity value of combined company through free cash flow to firm method, just cite the format first for the combined company. The format of free cash flow to company is revenue, then cash cost, then TAD, which gives you operating profit. Okay, then interest, but in free cash flow to company, interest doesn't come. Okay, it comes in free cash flow to equity. Okay, when you deduct interest, you get taxable profit. Then you pay tax. Then you add back TAD. Then you deduct investment in working capital. Then you deduct investment in NCA. Okay, you get FCF to company. Then you multiply it with discount rate, WACC, to get value of company, right? Then you deduct value of debt. So you end up with the value of equity. Okay, this is how FCF to company model works: revenue, cash cost, TAD, operating profit, then interest, taxable profit, then tax at TAD, investment in NCA, investment working capital, FCF to company, discount rate, WACC, value of company less value of debt to get value of equity. Okay. Okay, so I think this information is going for 720 in first year and then 8% in 2 to 4. So 720% rise. Okay, so there is no cash cost and TAD given, so you should end up with operating profit. Post tax, okay, that means tax has also been deducted. Post tax operating cash flows, 14% of revenue. Had it been pre tax, I would have written it here. Okay, had it been pre-tax, I would have written in these cells. It's post-tax, okay. So that means tax has already been taken down. So let me just check what we can adjust here. So I think I have to create a new cell here. Yes, because had it been pre-tax, I would have written 720 for B3, steric 0.14, but then interest comes and then taxable profit and then tax. Okay, so you are given post-tax. That means tax has also been deducted. Okay, interest doesn't come here, so I have to add a new row. That's post-tax profits or cash flows. They are 14% of revenue. So B3 steric 0.14. And you can drag it. I hope you're understanding my point clearly, because there is nothing more I can do here. Okay. Even though this row is not in the main format, but you have to be a bit smart and keep your mind intact that operating profit comes, then interest and tax comes, and then interest is deducted to get taxable profit, then tax. After that, we don't write post-tax profits, we just deduct investment and see. But since post-tax profits are given, I have to take them after tax. Okay, create a new row. Then it's add back T80, which is not there. Less investment in NCA, less investment in working capital. So FCF2 company discount rate gives value of company. You deduct value of debt to get value of equity. Okay, so you have just done the post-tax profit. Let's go back after what it is. And investment in NC is given 25 million year one and 0.3 for every $1 increase in revenue for 2 to 4. So 25 million in year one. It has to be deducted. No T80, investment NCA negative 25. And then 0.3 for $1 increase in revenue. So take the difference of the revenue increase, C3 minus C2, sorry, B3 minus C3 minus B3. This is the increase in revenue, but for every $0.3, so the difference 0.3, 17.28. Then take the difference in revenue, D3 minus C3 to 0.3. And then D3 minus D3 into 0.3. Okay, no investment in working capital, so you will likely to get FCF2 company. Okay, so it's the sum of B10 to B13, and then you can drag it. Okay, what's next? FCF2 company. Then it states after 4-year annual growth rate of free cash flow, 4% for the foreseeable future. That means 5 to infinity. Five to infinity. Foreseeable future. It's 4% price, right? Free cash flow will go to 4%. So this E14 is gonna grow by 4%. Okay, discount rate, what is the discount rate? It's 10%. So take 0.909 from the table, 0.826 from the table, 0.751 from the table, 0.683 from the table, and the last discount factor, that is E15 divided by WACC minus G, so 0.1 minus 0.06. Okay, this will give value of company. So it's B14 into B15. Okay, this is actually multi-let's present value. Okay, so present value of future FCF. Okay, so then you can do total present value of all future FCF, which is basically the value of company. Total present value of all future FCF is the value of company. So sum of B16 to F16. Okay, less the value of debt. So what is the value of debt here? This discount factor is a bit incorrect, sorry. It's a WACC minus growth rate, 4%, okay? So total present value of all future FCF is 1556, okay? This is value of company. You need to deduct value of debt to get value of equity. Now, debt to equity ratio is 1:3. That means debt 1, equity 3. So total capital structure is 4. Debt to equity means debt 1:3. Debt 1, equity 3. Total is 4. Okay. If you want to find debt percentage, 1/4, 25%. Equity percentage, 3/4, 75%. So value of debt, it's 25%. 1/4. So you can deduct B17 into 0.25. You get value of equity as B17 plus B18. Okay, 1167 is the equity value of the combined company as per the requirement equity value of combined company. Okay, so you can first copy this, then I will tell you the next bullet point, benefits which would be gained by PROPLIES shareholders from the acquisition. Now, if you look at requirements, the 10 marks were not for this equity value of combination of PROPLIES and ADICTA and equity value of combined company. Obviously, both companies combined equity value would be determined by free cash flow to firm method that was written in the question. Okay. Now, its next requirement is benefits which would be gained by PROPLIES shareholders from the acquisition. How much benefit PROPLIES shareholders would be getting? It's a very easy requirement, but you have to think a bit because mergers, every question requires you to think something. Okay, so benefits by PROPLIES shareholders. Okay, now if you look at this value of combined company is B19, right? Okay, value of PROPLIES individually was 620 equity value and 340 of adapted. So equity value because you were asked to find equity value, that's why you did value of company less value of debt, value of equity. So this is the equity value of combined company. You can see equity value of PROPLIES. It was 620 and equity value of adaptive, it was 340. Okay, so the equity value of combined company was 1167, but individual values were 620 and 350, 340, 960. That means additional benefit by combining both companies is 207, right? Just to get to know that how much benefit PROPLIES shareholders are getting. Okay, so this is the equity value of combined company 1167, right? Equity value of PROPLIES was given before acquisition. It's 620 and ADICTA 340. So 620, 340, it's 960 was the equity value, but of both companies. But the combined company value is 1167. That means by combining additional benefit is 207.331. Out of this benefit, okay, ADICTA shareholders want premium of 20% above current equity value. Okay. So this is the additional benefit by combining both companies. But 207 benefit, this will be benefit. This benefit will be earned by PROPLIES since it is buying. Okay, individual value of both companies is 620 and 340, but when you combine is 1167. So the additional benefit by combining both companies is 207. Who will get this benefit? The buyer. PROPLIES is buying, right? PROPLIES is buying. So this benefit will be earned by buyer, PROPLIES 207.331. But ADICTA shareholders need to be paid 20% above their equity value. So their equity value was 320 million, and they need to be paid 20% premium above their equity value. That means they will take 64 million of premium. So balance benefit will be for PROPLIES shareholders. So 143.53 million is your requirement answer. The benefit which will be gained by PROPLIES shareholders. Okay. PROPLIES shareholders will gain this full benefit because they are the buyers. When you buy both companies, combine both companies, individual was 623.40, when they combine 1167. So PROPLIES shareholders will get benefit of 207.331, but they have to pay 20% premium above the equity value to this Addictance shareholders, right? So the balance will be for them 143.30 million. That's it for the requirement. But if you want to check one more thing, how much percentage benefit, not required if you want, how much percentage benefit they are getting. So they got benefit, PROPLIES shareholders got benefit of 143.30 million, and their original equity value was 620. So if you check how much percentage gain they're getting, that's 23%, which is a good percentage. They were just demanding okay, they were just demanding how much? 20% of current equity value. Okay, they are getting more than their equity value, more than 20% of equity value. So they will opt for this offer. Okay, so this is your complete 10 marks. You can copy this. Okay, then we will move towards the next part. Okay. Okay, so after completing this requirement of 25 marks, which we have just done, let's move to the requirement to discuss the assumptions made in the calculation in part A, including whether expected synergies are likely to be achieved. Now, there are two parts to this question. Discuss assumptions made in calculations in part A. So I will write what are the assumptions I made in calculations in part A. Obviously, part A calculations have some assumptions. So I will first tell that what are the assumptions made in calculations in part A. And secondly, whether the expected synergies are likely to be achieved, whether I will achieve the expected synergies or not. So let's start. Assumptions made in part A calculations and whether the synergies are being achieved. So you can answer this on spreadsheet or word processor, your choice. Okay. So assumptions made in part A. What did you do in part A? Equity value of combined company. Okay. What are the assumptions used? Okay. So the first assumption which I'm seeing is that growth rate in years 2 to 4 is 8%. So it is assumed that revenue growth rate in year 2 to 4 is 8%. Okay. So you can just write some more things. After combining both, it's not a guarantee whether 8% is likely to be achieved. Okay. Profit margin is 14% of revenue. This is also an assumption. Profit percentage is also assumed at 14% and is assumed this will remain same for all years, which may be difficult because maintaining a stable profit percentage in each year may be difficult. Okay. After fourth year, free cash flow growth rate is assumed as 4% for the foreseeable future, and it is difficult to achieve a same growth rate till perpetuity. Okay. Assume a cost of capital of 10%. Cost of capital is also assumed as 10%. What are the grounds for it is unknown. You can also write one more thing. Target debt equity of combined companies assumed as 1:3. No principal grounds of that are also given. Okay. So 6 marks for comment. I've already earned 3 to 4 marks by assumptions. Now, whether the expected synergies are likely to be achieved. So what are the expected synergies? PROPLIES board believes acquisition could provide synergies, particularly in the areas of online presence, marketing, and cross-selling, and also savings in staff administration and paper costs. So PROPLIES, who is trying to make a takeover bid, he believes that this acquisition will give us some synergies where in online presence, marketing, cross-selling, savings in staff admin and paper cost. Okay, so the question is asking in requirement whether expected synergies are likely to be achieved. So we'll answer this, whether the expected synergies are likely to be achieved. Now, if I think whether the synergies are likely to be achieved, so synergy may result in paper cost, because obviously when two companies combined, they need to buy more paper. More paper means they can get bulk purchase discounts and can achieve savings and synergies. Can also be achieved in administration, okay, duplicative admin functions, but it is difficult to achieve synergies in staff because both have different staff. Remember, one has staff which are specialists and the other have young staff who stay for a limited time. So since staff are not the same, it is difficult that you get synergies in staff. Maybe getting, it's just a review. And online presence is also, one is very much good in online presence, other is not. So it is difficult to achieve synergies in online presence because the level is not the same. Okay. So you can write these views for 2 to 3 marks. As far are concerned, combining both companies may result in buying more paper, leading to bulk purchase discounts, hence synergies in paper can be achieved. Similarly, duplicative admin tasks can be eliminated, leading to synergies. But since staff of both companies is very different and online presence is also not same, it may be difficult to achieve synergies in these areas. Okay, you can write alternative comments as well. So this I have written, you can copy this, you can further elaborate this, it's your choice. Okay, now let's move to the last requirement. Explain actions which PROPLIES board can take to ensure companies are integrated successfully and synergies are realized. It's just 4 marks. Actions PROPLIES board can take to ensure companies are integrated successfully and synergies are realized. To ensure companies are integrated successfully and synergies are realized. PROPLIES needs to understand the organization culture of Adektan first. If organization culture of Adektan is very, very different from PROPLIES company, successful integration may become difficult. You know, this is a very important thing. You're acquiring a company, you want successful integration, but the culture of both organizations is very different. Successful integration is very difficult. So requirement is to ensure that integration is successful. What can PROPLIES do? So PROPLIES board can first ensure it understands the organization culture to ensure proper integration takes place, right? Secondly, IT systems of Adektan need to be carefully studied because differing IT systems make integration difficult. Finally, study needs to be made on employees and managers of Adektan to identify which to retain and which to lay off, as sometimes employees may oppose integration, so it is better to lay them off. Key employees need to be retained for successful integration. Okay, so looking at the IT systems, this is not just about this question. IT systems needs to be looked to ensure successful integration. Organization culture needs to be studied and understood for successful integration. Employees need to be studied. These are the actions that any company can take to ensure successful integration takes place. You can copy this, and that ends this question.